Okay, let's get started here. As many of you have received, I think, the note from Leo on speaker schedule, and also comments on homework 2 are posted, so you may want to look into them. As far as the speaker on Wednesday, he will be here, and he also said you could stay on for lunch if any of you want to go with him. And only problem is that I won't be able to do it because of other prior family commitments. I had to leave right after the class. And I also want to mention that one of the papers you're reading is John Scruggs' paper on pairs trading. And he is coming to my other class, 237 class, to give a talk. And I will let you know when exactly he's going to show up, because he hasn't committed the date yet. Once he tells me, I'll let you know. So if you want to come for his talk and talk to him about the pairs trading, that would be nice too. Okay. Before I get started, do you have any questions? Any questions? As you know, next week I think both classes are taken by the speakers. So I'm going to arrange at least one class next week so that I can make up the last week of classes that I won't be here, So that could be, I'll let you know what the times are, because it depends on the room availability and all that stuff. So once I know, I'll let you know. So I think, there are few more topics that I want to cover in depth. So it's important not to lose the class time. I'll try to come up with a time that's sort of in the evening time or something, so that most of you would be able to attend. Okay. So let me comment on, first I want to comment on the co-integration strategy. And the way we developed the co-integration was mostly from looking at multiple time series modeling point of view. Okay. So generally, I think, as I mentioned before, if you have a multiple time series, especially if the series are supposed to be non-stationary, we mentioned that you can let's say that P of t is a multivariate time series, and it has a structure pi of P of t minus 1 plus A of t, and the condition for the process to be stationary is that the eigenvalues of this matrix is supposed to be less than 1. So we mentioned that it's same as saying that P of t minus 1, the difference here, this we call it as delta Pt, should be modeled as pi minus I, results in this equation here, P of t minus 1 plus At. So if the eigenvalues of pi go to 1, you should expect the eigenvalues of this pi minus I should go to 0. So if this pi star eigenvalues go to 0, I mentioned that this could be taken as a lower rank matrix, so which means that pi star could be written in the form of two lower ranked matrices here, alpha beta prime P of t minus 1 plus At, and this beta prime is supposed to be let us say this, if it's rank r, you could write it as r times, let's say that the dimension of the price series is m, and this is supposed to be m by r. Okay. The key part of this is that you can see that this decomposition that I mentioned here is not unique. I could always throw in a constant that will affect alpha and the inverse of the constant that will affect beta prime. So this is not unique. So you need to impose some constraints on this decomposition. So there are various constraints people impose, but the key that I want to mention here is that whenever you have a co-integrating relationship, and if you want to use it for trading, you want to make sure that some of the components of alpha are positive, some are negative. If all of them have the same sign, it's not going to help you in trading. Okay, keep that in mind. Okay, so this is the decomposition, and so essentially we are saying that pi star could be decomposed into two parts here, alpha, beta prime. So you could always throw in some non-singular matrix here, P, and then say P inverse beta prime. Still I could call it as another decomposition, I could call it as alpha star beta star prime. So that decomposition is not unique. Okay, so this is something that I want you to keep in mind. So this can be extended to any number of lags, and we have seen that very similar to what we call as augmented Dickey-Fuller test. Okay, but there is a simple test which Engel and Granger give when you have only two variables, and that's a part that I want to cover later, which is useful in practice. Okay, before I cover that part here, this is based on a study by a group of researchers from Northwestern. So they looked at roughly about 5,000 stocks, and they looked at all possible pairs that can come out of it, and then they wanted to see if you go for the pairs trading, how long the profit lost. Okay, so if you look at this, you can see the profitability in basis points. It starts almost as 20 basis points, pretty good profit that you make, but you can see that the profits seem to vanish after 10th or 11th day. Okay, this is supposed to be daily data. Okay, so even in pairs trading, you'll see that the speed is important, how quickly you're entering, and because you can't make money forever, after a few days, I think the prices will converge and the profitability vanishes. Okay, so let me briefly go through this co-integration based trading. Okay, so if there exists a stationary linear combination of non-stationary random variables, the variables are said to be co-integrated. Okay. So generally I think we are going to write that if there are two variables that are co-integrated, we should be able to find some sort of linear combination that is stationary, and either you can estimate using this Johansson method, which is given by b prime yt minus 1 is pretty similar to that combination that you have there. Okay, so this sort of gives you a general test very similar to augmented Dickey-Fuller test. Okay, and most financial data, I found that once you difference the series, the maximum that you can pick up is lag 1. Beyond that, there is nothing much you can find. But this particular model here is generally useful for macroeconomic modeling. But when it comes to financial time series, generally I think Q is at most lag 1. Beyond that, I don't see anything happening. Okay, and there is also this variable here, d times x, and x is supposed to be other variables that could influence. Okay, so I have an application where you can use this for exchange rates. In the case of exchange rates, the country's general economic health seems to play a role. If that is the case, you can bring in other economic factors that are likely to influence the growth in the exchange rate. The other information can be brought in here. Okay, so but here I think for the purpose of trading, we are going to simply look at prices of two series. Okay, but if you want to bring in other company information that could help you to trade better, all that information can be clubbed into that x variable. Okay. Okay. So these are actually two future series, and you can see generally they are non-stationary, and both of them are trending down, right? And so you can find a mean reverting series, which is nothing but the linear combination of the two. And once you have that linear combination, you can use all kinds of things that we have done with the univariate series. Here I think we just did some sort of Bollinger Band, and once you compute the Bollinger Band, you can see there are some trading opportunities whenever it crosses the lower bound or the upper bound, you can do the trading. Okay, so I think one of the reasons why pairs trading is used often in practice is that it gives you opportunities on both sides. Okay, so these are the steps. You want to make sure that y1t and y2t are integrated to the same order. Integrated means that when you difference the series, it becomes stationary. That's integration means. Okay. So the usual test we are going to use is ADF test on y1t, ADF test on y2t. Okay. And briefly, I think we all know what ADF test is, but I'll go through one example you can show you. And then you can use the Johansson co-integration test on the vector y. And this is the way I would like you to think about when it comes to trading. When you estimate if there is co-integration or not during a period, you cannot jump into trading right away. So you need to make sure that the co-integrating relationship that you found holds for a certain period before you do the trading. Okay? So the way we approached this was that we call it estimation window and then the rebalancing window. Okay? And then if it holds in the rebalancing window, then you enter the trade. Okay? And usually the estimation window for this particular type of calculations, we use roughly 60 days, sometimes 60 days, sometimes 30 days. The rebalancing window, generally we use it for 15 days and then enter the market. Okay? And so we use all kinds of long and short criteria. And shorting means that once we reach a certain profit level, we quit. And or if the loss is pretty high, then you want to quit. So you need to put some multiple stop loss criteria in the model. Okay. And so if you plot the two futures, I think this is how it looks. So by comparing the two, you can see they are pretty much moving in tandem, right? They are going together. Okay. So that sort of tells us that these two series are likely to be co-integrated. Okay. So this is what we get here. I think somewhere, yeah, that's what we get. Okay. But before I do this, let me give you this. I think this is actually given in one of the slides that you have. Okay. So the steps that Engel and Granger give is the following: regress, log of one of the prices, PFTA, on the second one and compute the residuals, epsilon t. Okay. And then the next step is to regress. So this is without going through any computation of eigenvalues or eigenroots. This is some sort of straightforward method that you can use. Okay. So the regress then, the error term epsilon t on t minus 1 plus some at. I think the key here is that use Dickey-Fuller test to test for stationarity of epsilon t. That's the key. Okay. So there are a couple of tests that you can use, and let me tell you that the same as compute the residuals can get the pi hat, and then you can use standard tests here, t ranging from 1 to capital T, epsilon t hat epsilon t minus 1 divided by 1 to t hat square. Okay. And then the variance of this sigma squared A, this is given as just the residual term here, t ranging from 1 to capital T epsilon t hat minus 1 squared divided by t minus 1. Okay. So, the Dickey-Fuller test is nothing but computing the t ratio which is given as pi hat. I think that here is the key that I want you to keep in mind. The hypothesis that we want to test is not pi is equal to 0, hypothesis that pi is equal to 1. The alternative is that pi is less than 1. So, that is the test we want to use. Okay. So, essentially the t test that you want to compute here is same as pi hat minus 1 divided by sigma hat A times square root of t 1 to t minus 1 square. Okay. So, this is like simply running a regression type of calculations, and you can show that the denominator that you have is nothing but standard error of pi hat. So, you can run a simple regression and you can get the t distribution, okay, t test statistic. The key here is that the test statistic does not follow t distribution, it is a non-standard distribution. So, this is where you need to refer to the tables that I have posted on the course site. Okay. So, this is same as taking this epsilon t, and the second method I think which is coming from Dickey-Fuller test is that you can look at the differencing here delta epsilon t, which is epsilon t minus 1, and if you subtract it, as you know, same as pi minus 1 epsilon t minus 1 plus some a t here. So, you can run the regression of delta epsilon t on t minus 1 and check whether this quantity is 0, and the t test statistic you would get should be exactly same as the one that you see here. Okay, exactly same as the one. Okay. So, if you look at the data that I have posted, I will come back to this little later. If you look at the data that I have posted here, I did the analysis on the two pairs that are mentioned in, let me go here. Anyway, you can see this. So, let's so this is the two stocks that mentioned in Say's book. One is BHP, the other one is Whale. And if you look at the two stocks, I think they are sort of moving together, except the first one seems to go much faster rate. And so, when we run the regression, so I did the regression, the first regression here. So, you can see what we get here is that P of 1t is 1.82 plus 0.717 P2t. So, essentially what we are saying here is the following. So, we are looking at P1t and then minus 1.82 minus 0.717 P2t, I think we are saying that this is supposed to be stationary. So, it is supposed to move around a certain average. Okay. And then I also did I mean, quick way to check this would be to see the Durbin-Watson test statistic, which essentially measures if there is any first order autocorrelation. So as I mentioned before, the Durbin-Watson is supposed to be roughly equal to the following. This is 2 times 1 minus first order autocorrelation. Say if autocorrelation is close to 1, you should expect this value to be close to 0. And if it is close to 0, you can see it's supposed to be 2. So essentially, if you look at this Durbin-Watson test statistic, ranges from 0 to 4. So values close to 2 seems to indicate that there is no autocorrelation. Values closer to 0 would indicate that there is a positive autocorrelation. Okay? This is just a quick way to check before you get into any ADF test or anything like that. Okay? So once I have this information, I computed the following. So this is supposed to be the autocorrelation of the residuals here, and you can see the partial autocorrelation is close to 1. Okay. So when I go through the actual test, so this is what I get. Okay. So the two series that I have are given here, P1T and P2T. This is supposed to be WT. WT is nothing but just a version of this quantity that I mentioned here. WT is stationary. Okay. So what is how do you exploit the stationarity? The idea being that if this crosses 2 standard deviation limits, that indicates that you can make the trade. Okay. You can swap one at the with the other. Okay. And then I also ran, as you can see, if I put it in the matrix form, I can run the regression of the difference of P1T on W1T, and similarly I ran the regression of P2T on W1 lag 1. So essentially what I did was to go back to this equation that I have here. So I have this beta prime P of T minus 1, which I have estimated to be P of T minus 1. So in this case we have 2, so the rank is equal to 1. So this is 1 by 2, this is 2 by 1. So from here we said this is equal to P1T minus 0.717 P2 T minus 1. So you don't have to have T minus 1 or T, but just let me write it here. That's what we said. Right? And 1.82, the constant is irrelevant because when you look at the differences, it's going to vanish. Okay? So once I have this, I want to see what is the value of alpha is. As I mentioned last time, I can take this delta PT and regress it on this beta prime PT minus 1 to recover what alpha is. Okay? So this is same as the whatever WT that you mentioned here, without the constant term 1.82. Okay? So when I run this regression delta PT on this beta prime P of T minus 1, I have these coefficients that are mentioned here, and you can see the first one is the difference here P1. So let me write this in the form here, P1T, the difference. The second reference is that P of 2TD. So this is exactly equal to this equation that I have here, delta PT, delta PT. So now I have beta prime T minus 1, which is given by this WT. So I have this WT here. So I have 1 and WT. So I have this constant term and also the alpha term that goes with that. Okay. So when I look at the first equation, you can see I run the difference value of the first price on W1T. I get 0.131, and 131 and 0.07 minus 0.0711. I run the same thing for the second one, and so that is the regression that I have, which is given as, you can see, minus 0.0596, 0.0596, and the second term is that 0.0338. 338. Okay. So in both cases, you can see I think I have it here. Let me briefly go through this. The first one, you can see what is the Durbin-Watson I'm getting here is 2.14. Can you see that it's closer to 2? So once you have it, there is no autocorrelation in the data. Okay, and same thing when I do this here for the second regression too, you can see Durbin-Watson is 1.86, close to 2. So you remove the autocorrelation by going through the calculations that I mentioned. Okay, but couple of things I want to mention before we go to other discussion here. Remember, I mentioned that these alphas here should have opposite sign if you want to proceed. Okay, when I say alpha should have opposite sign, I mean exactly this column here. This is the alpha column that we talked about. This is just a constant. Okay, so can you see that the alpha column here is the opposite signs? So which means that this combination can be used for trading. Okay, and if alphas have the same sign, it's very difficult to make money because both are going down at a certain rate, so it doesn't really matter. Okay. Oh, a couple of comments. I think for the data set that you are currently looking at for the homework assignment, I have used it before, and you'll see that the rank happens to be not 1, its rank is equal to 2, and you'll also notice that the first correlation canonical first combination will not yield much. You have to go for the second combination. The first combination, alpha coefficients have the same sign, so it cannot be used. You have to move beyond first coefficient. Keep that in mind. Okay, so I spent a little bit of time on that problem because we're trying to use it for actually trading purposes, and the initial first component was not yielding us any, giving us any information. So when I kind of looked deeper into it, I found that the second combination is more profitable. Okay, so something that I want you to keep in mind. Okay, so going back to this approach that I mentioned, Dickey-Fuller test, I want to briefly comment on it because I do have all the calculations that I so I went through these calculations here, and you can show that pi hat value is 0.905, and you want to check whether it is close to 1. Okay. So essentially I computed the regression here, and then using the regression that I have seen, we have gone through before, computed the residuals, and then looked at the lag 1, go through the t ratio here. So you can show that pi hat is equal to 0.905, and the standard error of pi hat is given as 0.01348, and the t ratio you can show is equal to minus 7.07. Okay. So the same ratio, t ratio, you should get even when you go through the second method. You're taking the difference and then regressing on the lag 1 variable. Okay. So now you have to decide whether this is significant or not. If you go to the tables that I have posted, you will see that this value is way below the table value. So that indicates that you would you would reject the null hypothesis, that pi is equal to 1. So, here I think the hypothesis is that pi is equal to 1. Let's keep in mind. Okay. Similarly, when it comes to this differencing process and going through this step here the hypothesis is that pi star, the coefficient, is equal to 0, and you will see the t ratio that comes out of this is exactly same as the t ratio that you see here. Okay. So, going back to the approach that we took here, you can see that is we talked about the initial investment was about $24,000, and going through this, I think this is over a period of 1 year, I think, 927 to over a period of 10 years, I think. So, when we went through the calculation, you can see total number of trades happened to be 21, and there were 17 winning trades, and that is the equity curve that you see. Sharp ratio is and looks pretty good. Okay. I think the main concern we had with this approach was that for such a long period of time, we were able to make only 21 trades. Okay. And this is based on daily data. Okay. So, now we are digging deeper into it, trying to see at looking at 30-minute data to see whether this will work. The main problem going disaggregated data is that co-integrations could be pretty iffy because it may hold for a certain duration, and then when we do work for the rebalancing period, it vanishes. Okay. So, you have to balance between which time aggregation is appropriate. Okay. Okay. Any question? I think that pretty much finishes the co-integration based strategy that I was planning to cover in the class. Okay. So, in order to help you to complete the assignment, I want to switch topic here. I am going to leave a few things in between. I will come back to it after we finish that other topic here. I want to talk a little bit about this last one that you are supposed to use for the, okay. This is a directional test. Okay. So, the two papers are that where this lecture is based on are given in the reading list, but the idea for this paper is not new. Actually, there is one old work by Rydberg and Shepard, and they take this any change in price as consisting of three components. One is that if the change is going to occur. Second is the change is going to be positive or negative. And the last is what is the size of the change. Okay. So, you can model these three things independently and then try to see how you can combine them using some copulas and other functions. Okay. Here the same concept is extended, but I think the most important concept here is that can you predict the change in the direction? Can you predict the direction? Once you predict the direction, you can say how much is the change. Okay. So, let me go through some details here, and the manuscript that I posted for my book has some more details here, and okay. So, you can take a return here and write it as follows here: C plus absolute value here and sine of RT minus C. Okay. So, what is the value of C? C is the rate that you expect to have. Okay. So, it could be risk-free rate, or you can set some limits there. Okay. So, this is same as writing C plus RT minus C. So the sign could be written as 2 times this indicator function, which is given as minus 1. Okay. So you can show that the expected value of this R of t is given as C minus expected value of this t based on data up till t minus 1 or t minus C plus 2 times expected value of t minus 1, and then this is RT minus C indicator function RT greater than C. Okay. So that is the decomposition that comes handy to model decomposition. Okay. This is similar to, as I mentioned, if any of you are interested in reading Rydberg and the Shepard model. Actually, the reference to Rydberg and Shepard is given in the. Okay. So the key for this modeling is as follows. Let's assume for the time being C is equal to 0. If that is the case, so why is this decomposition superior? Okay. Okay. Suppose we know that return is related to some factors. We all know that if the market is truly a random walk, returns are not predictable, right? But if there is some way we could relate the return to some factor, then I think this leads to a little bit superior models here. So generally I think, suppose RT is related to realized volatility time t minus 1. So essentially we are saying that previous day's realized volatility can tell us something about today's return. Okay? And if that is the case, you can show that the absolute value of RT coming from here is given as alpha. I think this is a notation they use, beta R, RV, t minus 1. And the direction of this, like what is the probability that RT is going to be positive based on the data that you have up to t minus 1. And suppose this is also related to, say, realized volatility t minus 1. So combining these two, expected value of t minus 1 of RT, combining this you can show just the product of the two, alpha R plus beta R, RV t minus 1 plus gamma R, RV t minus 1 square. Okay. So the main idea behind this modeling is that it can accommodate nonlinear relationships. Okay. And I'll tell you, I'll make a few comments here based on the data I've seen. This is It makes some improvement, but it's not whole lot of big improvement that you see here. Okay, non-linearity. Okay, so okay. So in practice, how do you model this? Okay. So the approach they have taken is as follows. Okay. So I'll say two models here. Okay. So model here. Okay. So this RT minus C absolute value, the change that you are looking at, is modeled as xi of t, eta t, where eta t is taken to be Weibull distribution. Okay. Because of the extreme value nature of the absolute return distribution. Okay. And then xi of t is like the variance or the standard deviation of this quantity here. So essentially log of psi of t is a function of psi of t minus 1, similar to some sort of Gorge type of model here, RT minus 1 minus C plus the indicator variable that you have in the previous period. The key is that you are using the information from the previous period, and then some xt minus 1s, these are taken to be some macroeconomic variable. Or this could be also related to some sort of stock type of information. Okay. So, by the way, I want to mention that people have found that during the time of announcements, earning announcements and other times, you will see that the volatility of the return changes somewhat different from during regular times. Okay. So, there is some information coming from macroeconomic data too. I think same thing they have found whenever there is information on unemployment rate, there is some volatility around that period. Okay. So, this is for modeling the absolute value of the return. The second model is you need to decide the direction of the return. Okay. So, here I think the indicator variable RT greater than C, by nature this is supposed to be either 0 or 1. So, this is a Bernoulli process. Okay. And assume that this happens with P of t, and P of t is modeled as logit model with some theta t. Okay. So, essentially we are assuming that this P of t follows logistic distribution, and then you can get this theta t, and this theta t again is supposed to be a function of the indicator variable based on previous day C, and then some other macro factors. This is the macro variable. Okay. Okay. Now the question I think is that how do you model this jointly? And so this is where I think they use this copula functions. Okay. Model this jointly. By a copulas. Okay. Okay. What is the idea behind Coppola functions? Does anyone know? What's the idea behind Coppola functions? So I think, traditionally we tend to use normal distribution for univariate data. For the univariate data, a lot of work has been done on other distributions. When it comes to multivariate data, bivariate, trivariate data, people still tend to use bivariate normal distribution and so on. Okay? And this bivariate normal distribution has a nice property. It is the main usefulness of bivariate normal in practice is that the conditional expectation is supposed to be linear, which is the main part of the regression. It gets used in many different contexts. Okay? But how do you extend this bivariate normal to other distribution has been a big topic of discussion. And I think, extending it to some study done on bivariate gamma distribution extensively, but moving on beyond this, few distributions that are very well known has become difficult. So essentially the idea here is that the marginals could follow any distribution you want. The joint distribution can be modeled through some sort of function that links the two. That's where the Coppolas come into play. Okay? So it's based on the following idea. So let me write it here. Okay? So you want to model this jointly here. Essentially you want to model the change and then the indicator function. Okay. So given all the information up to this point, it minus 1 means that information you have up to this point. Let's assume that this follow some PDF here. Okay. So these are the probability density functions that you have. Okay. So Coppola is nothing but constructing multivariate function V based on uniform random variables. So you can get uniform random variables through the CDF of these distributions, RT minus C U, and similarly f of the indicator function that I have here, RT greater than C of B. Okay. And C of W1, W2, any arguments that you have here is a Coppola. Okay. The key I think is that there should be a distribution function. It's a bivariate CDF. Bivariate CDF. Okay. So there are various Coppola functions that are used in practice here, and I'll just give you there's a whole list of them that you can use. Clayton Coppola is essentially C of W1, W2 is given as W1 to the power minus alpha plus W2 to the power minus alpha minus 1 to the power 1 over alpha. And then the one is Farley, Gumbel, and Morgenstern. I think many of the ideas came from developing joint distribution for extreme value distribution. They were not able to relate the two extreme value distribution via bivariate normal. So they came up with all these things. So Gumbel distribution is one of the extreme value distribution. So here I think C of W1, W2 is given as W1 times W2, 1 plus alpha W2. Okay. And I think this gives you a little bit interesting. Alpha is supposed to be a number between -1 and 1. If alpha is negative, that shows that the two distributions have negative dependence. If it is positive, positive dependence. Okay. I would suggest that look at these models that I have given here. Based on the models, you need to decide what the dependence is, and using the dependence, you need to come up with some sort of copula that comes up with a better fit. Okay, I've listed only 2 of them. There's a host list of them here. Okay. So in terms of trading strategy, how do you use this? Okay. So let me. This is the strategy that is mentioned in the paper. I think it says that buy shares if R hat of T is greater than C, sell otherwise. So that is the simple strategy they mention, and you can always modify this strategy in many different ways. You can say that constant C plus something, then you buy, otherwise sell. Okay. So these are the variables they look at. So I mentioned the realized volatility of T is given as. So if you are looking at monthly data, realized volatility could be taking days in a month and then look at squared returns. That should give you the estimate of realized volatility. And then they also look at, forgot the bivariate kind of volatility here, and this is nothing but 5 over 2 m over m minus 1 s ranging from 1 to m minus 1 r of Ts and r of T s plus 1. This is some sort of measuring the time dependence here. Okay. And they also do some sort of skewness indicator, which is given as s ranging from 1 to m or T s to the power 3. They also have Curtis's kind of indicators, essentially reusing the data past returns as efficiently as possible to the power 4. Okay. But even with all this, the improvement in prediction seems to be somewhat marginal. Okay. But I think in this kind of data where things appear to be totally random, the best you can do is to use the past data, past returns as effectively as possible. Okay. So the reason I wanted to bring this up was that among the trading strategies I've seen on the univariate side, this is probably one of the newer strategies that's mentioned. Okay. And I think the main idea behind this strategy is, as I mentioned, is that you want to measure not only the change but also measure the direction. So you combine the two. Okay. So that's the main idea here. Okay. You can look at the original paper. They do mention some of the macroeconomic variables, but they don't seem to play that important role in the long run. But there are studies that show that during the time of earnings announcement or any major macroeconomic news, you can generally see there is higher volatility in return. That information should be incorporated into the model. Okay. Okay. I think that's finishes here. I want to briefly talk about this momentum strategies. I think here the slides are a little bit not aligned properly. Okay. What exactly is the idea behind the momentum strategies? Okay. I think this is a study that kind of, these are the authors who kind of propelled a very large number of papers in finance. Okay. What's the idea behind this momentum strategy? Okay. As I mentioned before, the way the momentum is discussed in finance is that it is not time series momentum, it's mostly a cross-sectional momentum. What is a cross-sectional momentum? Cross-sectional momentum is that you take a group of stocks and follow them over time, you see how well they do. Okay. Here the main idea, I think they looked at almost all the stocks that were traded during a certain time period, and then they divided these stocks into 10 groups based on their performance, and they put more money into the top decile, took the money out of the bottom decile. They can show that the top decile one continue to perform well. That's the main idea behind it. Okay. And this is a general idea is that you want to form the portfolios based on the past J months return, and you want to evaluate those portfolios based on the next K months return. And there are 10 decile portfolios. Buy the top one, sell the bottom one, and you can see that this is based on 1965, 1989 data. This is a monthly data, and generally people have shown that this also holds for daily data too. Okay. And if you look at it, this is a simple study where they want to what should be the period when they form the portfolio, how long they should hold. You can see based on this which return seems to be the maximum here. So it's sort of a tie between the two. You can see that forming the portfolio using 6 months data and holding the portfolio for 3 months seems to work out well. Okay. So the question I think is that this is a little bit of a contradiction here. I think in the case of univariate series, in the case of one single stock, I mentioned that contrarian strategy works well, buy low, sell high. Whereas in the case of momentum strategy, if you are looking at group of them, you can say that buy the ones that are doing well, and they tend to do well in the future. Okay. So I think there is a little bit of contradiction that one has to look into. Okay. So I think then they also wanted to see if is the difference between the two comes due to relative riskiness. Okay. How do you measure the riskiness of the asset? You can relate the returns on the asset to market return and get the betas, and then you can look at how the betas are different. And they've shown that the difference due to relative riskiness, there is no difference at all. And then looser portfolios have larger sensitivities to farmer fund size and book to market factors. So this was the main study that was done. Okay. But I want to show you the paper that kind of went through the details is given by this. Something is missing here. So this is a useful slide to know. Okay. So let me briefly go through this. Okay. So you take all the stocks and compute the returns based on certain period, and then the portfolio weights are given by equation 4. What exactly is given by equation 4? What is the idea there? Okay. Remember, I mentioned that you divide the stocks into 10 deciles, put the money in the stocks that are in the top decile, and they tend to do well in the future, right? So that's the idea here. And WIT is supposed to be the weight given to this particular stock based on how well it does compared to the market rate of return. So this is a simple way of looking at how you want to allocate how much money you want to put it in each stock. Okay. This is just to get through the algebra. I think they kind of assume this kind of simple structure. Okay. Do you follow what WIT actually gives you? WIT is the first component is the return, right? R of IT minus 1 is the return based on the previous day, and RMT minus 1 is the return on the market, right? So if this particular stock is doing better than the market, you are going to put more money into that stock, and how much money you are putting is directly depends upon the difference between the stock performance and the market performance. That's the idea behind it. Okay. So you can show that if you write down the mathematics of this, you can show that if mu is the average return and capital omega that is given here is supposed to be the lag 1 autocovariance matrix, because you are looking at autocovariance of T, and you can write down the profit that you make based on this allocation is given by this pi t, or not the return that you get is based on this, and you can show that by going through this simple calculation, expected value of this return can be decomposed into three parts here. Okay, let me briefly go through that because it's a interesting decomposition that's useful to know. Okay. So we have this pi of t, which is the return on the portfolio, I, WIT, and R of IT. That's what we have. Okay. So keep in mind that W can be negative too, right? If the return on the asset is less than the market return, it's going to be negative. So essentially we are saying that short selling is possible, right? Just to show this algebra here, that's the assumption we make. If the short selling is not possible, this WIT is going to be 0, right? So here for the sake of calculation, we are going to assume that, okay? So that's what you have. So this is same as writing here sum of I, and WIT as per the definition that we have here, it's going to be based on the previous day's performance, or of IT minus 1, to put a dash here, minus RM T minus 1 times R of IT. Okay. So if you look at this, expected value of this pi of t is equal to 1 over n. There should be 1 over n somewhere. Sorry, it should be 1 over n here. Okay, get 1 over n times expected value of just these two quantities here, sum of I, R of I t minus 1 times R of I t minus 1 over n, expected value of Rm t minus 1 times sum of R of I comma t. Okay. So, you can show that this is same as writing 1 over n. This is rho of I plus mu of I square minus this entire quantity you can show that is equal to rho of m plus mu of m square. So, rho of I is nothing but rho of I and rho of m or lag 1 autocovariances of asset I. And then asset I and the index, the market index, whatever way you compute it. Okay. So, this is the so you can take the same quantities that I have here and put it in the form of this matrices here. You can write it in this form here. The key part of this is that you can take the expected return on the portfolio and decompose into 3 quantities here, and all those 3 quantities have some definite meaning. And what is the interpretation of this? I think it's all somewhere something is not right here. So these are the 3 components you have. Stock return is positively autocorrelated, so its own past predicts high future return. So what is the first statement? What does it say? What is the first statement? Stock returns are positively autocorrelated, so it can use the past returns to predict the future, right? And we know that for low frequency data, there is not much autocorrelation in the data. For high frequency, there is some autocorrelation, right? But in this case, what it means is that there is a time series momentum. Okay? The first component essentially captures the time series momentum. Okay? The second one says that stock return is negatively correlated with the lag returns on other stocks, so their poor performance predicts high returns of the others. So what does the second term mean? The stocks are highly correlated, right? If one doesn't do well, the other one is likely to do well. Okay? The last one says stock has simply have a high unconditional mean relative to other stock. So this just means that some stocks have higher alpha than others. Okay? So you can take this overall return that you see for the portfolio that you construct, you can decompose this into 3 parts here. In fact, studies have shown based on, I think it's based on daily data. I've seen studies that show that among the 3 components, the first one and the third one tend to dominate the profits, okay, returns. Okay. And it's interesting to know, I think there is a recent paper from NYU and focusing mostly on the top part of it. I think they sort of mentioned that the time series momentum generally tends to dominate the decomposition that we have. Okay, so I think I'm thinking of adding an assignment 3. There is a problem that I would like you to test this out because this is a interesting phenomenon. Okay. Yeah.
So, basic question: what is N in this? Is it
N
the
is
portfolio?
The total number of stocks that you have.
Okay.
isn't, I mean, do the weights would add up to 1 in some sense, or I mean, is there a, I mean, the ratios here for the weights doesn't seem to add up to a full
I think,
portfolio.
in the calculations, I'm assuming this is equally weighted index, right? Yeah. Otherwise, doesn't add up, right?
Other question is, doesn't
Momentum show, I mean, it feels to me like it's a self-fulfilling prophecy in some sense, right? I mean, you invest in the top decile, you expect it to go up, and it will kind of fulfill itself, right? I mean, if you had invested in some other place, you would actually probably make that as your growing stock or something, right? I
No,
mean,
but I think, this is actually based on data that gets validated, right? You invest and check it out in the next period. It does do well. And the question, I think, is that why does it do well? I think there is all these theories about herding behavior, and people put more faith in things that it seems to do better than others. There's all kinds of theories,
so
speculation.
in some sense it is also self-fulfilling, right? I mean, you
Right.
invested in the top stocks,
and if the top stocks continue to do well,
Right, but if the stocks are not worth it after some time, the profit should come down, right? That's not what's happening. Still, stocks are holding up. Any other question? I think before I do that, I think in the first study that I mentioned, Jagdish and Titman study, we have shown, it's been shown that the top performance stocks tend to do well in the future. Okay, there we group them in terms of the past returns. Okay, recently one of my co-author sent me a paper which I think is this study here by Han, Young and Zhou. I would like you to take a look at it. Here what they have done was, they, instead of looking at the returns, they divided the stocks in terms of volatility. So they put the stocks into 10 groups. The top ones had a higher volatility, the lower ones had low volatility. So if you put money into the stocks that had higher volatility, they tend to do well in the future. It's not the return, average return, it's mostly volatility. Okay? So it's not clear, there is no algebra like that I've mentioned here to show that why it should do better. It's another area that I think we should test it out why it does well. Okay, so that's all I want to cover today. So if you have any questions, send it to us and we'll try to answer them for you. Okay, I'll stop here.